Well, folks, my hat's on backwards, which means I'm not too happy. Cheesecake Factory, a cake stock, a stock I've been buying very aggressively the last number of months. This stock, after hours, is at multi-year highs. Now, you might be thinking I'd be jumping for joy in regards to this situation. Multi-year highs on cake, a stock I've been buying heavily? Ooh, that's phenomenal. No. I'm not happy at all. We'll speak about that. We'll get into, I want to react to that, okay? Then I want to react to a few videos here from this afternoon that I thought were interesting. Lean into discomfort of owning an expensive market, says Julian Emanuel. I think that's an interesting viewpoint, and I want to react to that one. I want to react to this one from just a few hours ago. Buy high and sell higher, says Dan Greenhouse. Looking forward to reacting to that one. And then Edward Denny actually went on CNBC this morning. I didn't get to see this yet, so I want to react to this. U.S. continues to surprise the upside. So yeah, we're going to get into that. Appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for smashing that thumbs up button. And thank you for being subscribed to the channel. Appreciate each and every one of you, okay? Now, what I don't appreciate is what's going on here in regards to cake stock. So, once again, up to about an $85,000 position in the public account, $15,000 plus. I also have a big position in my Patreon portfolio. I own shares of this, my private portfolio. So, it's a very good stock for me. It's been treating me very well, even very early on in the investment. And then it's up a bunch after hours. So, you know, I'm probably up many thousands of dollars more after hours if you add up all my different portfolios. But I'm not happy because here's what's going on here. Here's what's going on. Activist investor urges Cheesecake Factory to explore a potential split. Houston-based activist investor JCP Investment Management is urging Cheesecake Factory to explore the possibility of creating a separate public company by spinning off its three smaller brands, according to the Wall Street Journal on Monday. JCP Investment Management, which has built roughly a 2% stake in Cheesecake Factory, has privately told executives that North Italia, Flower Child, and Culinary Dropout brands would be better off as a separate company, Wall Street Journal reports, citing people familiar with the matter. Obviously, Cheesecake Factory is up a bunch after hours because people are thinking, well, if they split up Cheesecake, maybe there's a lot more value. First off, that's true, 100% true. In the very short term, there would be a lot more value derived from splitting Cheesecake Factory away from these other brands. Short term, yes. Like if we're just talking like money in my hand today, yes. Cheesecake Factory is a significantly undervalued asset. It trades at a forward P of somewhere in the 12 range if we were to check on 1000xstocks.com right now, right? That's insane, especially considering this is such a stable restaurant chain, plus they have these major growth vectors of the company. So there's no doubt, I agree with JCP in respect of like way more value derived in the short term if they split off Cheesecake Factory, but that does not mean that's the better long-term decision. As somebody that's thinking about stocks I want to own for many years to go in the future, I don't like this at all, just to be quite frank, right? Now, there was a song playing on my phone. It was a perfect song. It says, "Nobody does it better." Do you know that song? Nate Dogg, Warren G? You don't know about that. But anyways, okay, listen. It's insanely hard to create one restaurant that is good quality and successful. I mean, insanely hard. I'm just talking one location. Ask anybody that's from the restaurant business. They're going to tell you it's ridiculously difficult. Now, when you talk about expanding restaurants all over the United States of America, or dare I say all over the world, it's a whole other issue. It's insanely hard to do this. This is why companies like McDonald's and Starbucks are valued with such unbelievable valuations on them, because they're able to basically, if you go to McDonald's in Kansas, it's going to be likely the same exact quality that you would go to a McDonald's in Seattle. Like it's the same thing. And that's incredible, but it's extremely hard to do. Cheesecake Factory's done this over time. If you go to Cheesecake Factory in Charlotte, North Carolina, it's going to taste the same exact as the Cheesecake Factory you go to in Henderson, Nevada. It's the same thing, right? That's ridiculously hard to do. And that's why there's actually very few big restaurant chains that are super successful and super profitable, because it's so ridiculously hard to do, because all it takes is one night of bad service and you might have just turned off your core clientele base, right? So the moral of this story is Cheesecake Factory knows how to do this. They know how to expand restaurant concepts all over even the world, because there's Cheesecake Factories even outside of the United States, right? And they know how to do that in a very successful manner, right? And so they're now doing that with North Italia. They're now doing that with Flower Child and Culinary Dropout and their other brands they own, because they own other brands other than that. And so they're pulling this off, and that's ridiculously hard to do. And trust me, like FRC, Sam Fox, he would have, if he really wanted to go crazy with those brands and expand them all over the United States, he could have done that, right? But he understands as a restaurateur how hard it is to keep that quality high. You got to have a whole management team, and you got to have managers on managers on managers. You got to have managers of market. I know just coming from Quick Trip how high our standards were in the management levels. You had the assistant managers. Above that, you had higher level assistant managers, then you had higher level assistant managers, then you had your store managers, then you had your training managers, then you had your supervisors, right? Then you had your district managers that were usually just basically they had one state to worry about, right? Then you had your regional managers, and then you had managers over there. You had all these chains, so everybody keeps everybody on their toes. So you keep everything at a high level and no one can slack off, or there's like a next manager is there to say, what are you doing here, right? So there's like a whole chain. That's difficult to do. And you got to have all those managers be very high, very high quality. It's ridiculous. It's a whole process. It's insanely hard to do. Trust me, if you've been in the business of expanding locations over time, you know it is, right? It's ridiculously hard. It's more than just opening it up and saying, here's our new place and it's got the same name as all the other states. No, okay? So that's part one. Part two here is Cheesecake Factory is an absolute cash flow machine. This company produces incredible operating cash flow, right? It's a profit machine, this company. And so guess what? All that operating cash flow this company's pouring off quarter after quarter after quarter, year after year after year, that money can go into expanding North Italia locations, Flower Child locations, other concepts, and they don't need to worry about issuing debt or anything like that. And then they also pay out fatty dividends as well, right? And if they took away the dividend, they could expand locations even more if they really wanted to, right? But all that cash flow. So then the company doesn't have to worry about raising debt or anything like that. They're just able to produce these incredible profits and pour them into these locations. Then these locations become profitable. And a lot of times they become profitable actually rather quickly. And then they start producing more cash flow so they can expand more locations. More locations, just keep like the locations, just being spread more and more and more, which is incredible, right? And it's a whole system you have to for these locations to be successful. Because if you look at North Italia reviews, just about anywhere they open a North Italia, it's usually like 4.4, 4.5, 4.6, 4.7. That's ridiculously hard to do. Once again, ask anybody in the restaurant industry how hard it is to keep your reviews very high like that. They pull it off because their quality is so good, service is so good, anywhere they open, right? And so this is the cash flow machine. So when I see a Cheesecake Factory restaurant, I don't see what a usual person sees. A usual person sees a restaurant there. What I see a JP Morgan Chase there. I see a bank. I see a bank, I see an ATM, a cash flow machine pouring off money to then expand into these other brands. That's what I see. Now, do I think Cake could do a lot better job of explaining their value proposition to Wall Street and to investors? Yeah, absolutely. I think a lot of people just hear Cheesecake Factory and they just think of the Cheesecake Factory concept and they have no clue about North Italia or Flower Child or any of these other concepts. Otherwise, Cheesecake Factory's forward P right now would easily be in the 20s. Easily in the 20s right now. Wouldn't even be close. It would be like probably maybe 25, 30 forward P on this one if they really understood that. But I don't think the management team's maybe done a good enough job explaining that to Wall Street. So which maybe means they got to put more resources into investor relations, into getting Wall Street to understand what's going on here with the company, why it matters, how big their opportunity is here, right? And then people will begin to understand, okay, this company deserves a lot bigger valuation than, let's call it what they've been putting on with the company. So, that's my opinion in regards to this one. I'm not a happy camper if they try to split this one off. They need to keep it all as one company. It works perfect. Like, keep doing your thing, Cake. I hope these investors can bring more attention to Cheesecake and then kind of take things from there, okay? By the way, real quick here before I get into all this, just so you guys know, in the next few days, we're going to be raising prices on these two Patreon tiers right here, the Buy the Dip and Never Trip. So that's access to see the stocks I'm buying and selling each week, along with my Discord chat. And this one, same exact thing, but you can also get access to Become Master Stock Market. The iMob is about to start taking their 30% cut here very soon. Now, Patreon worked out a deal with the iMob that essentially anybody that joins over the next few days or joined in the past, the iMob won't get that 30% cut. But they're coming for their 30% cut, so we're about to make this move here very soon. So if you want access to that before the 30% price raise on all those tiers, Check out the pinned comment down there here today if you care about the stocks I'm buying and selling each week, seeing that in the Discord chat and all those sorts of things, okay? Because IMOB's coming. They're coming for the cut, man. It's coming very soon. Next one up here. Lean into discomfort of owning an expensive market.
Managing director at Evercore ISI slipped in here on
Snuck
in. Julian, great to see you.
Great to be here.
You make the point that it's been a tough bull market. Everybody wants to find a reason to not believe this one. It's too good to be true. Why do you think that is?
Well, first of all, because when you think of this set of circumstances, right, you threw everything you had at the pandemic. Then you had, sort of a speculative top in SPACs and profitless tech in 2021. And then all of a sudden the Fed was doing what we knew they had to do in response. And the speed with which they did it, here we are. We're still the economy that's the envy of the world. And you're actually now at a point where at 24 times trailing, you're very, very expensive. That's probably why you saw that note this morning from our competitor. But what we would say to that is, tells us the wall of worry is still very, very intact. And I mean, if you think about it, yeah, the VIX is low compared to maybe longer run history. But actually, if you think about the inertia of the markets the last several weeks, the VIX is high, and it should be in front of probably one of the biggest unknowns we've been facing, certainly in the last 4 years, if not longer.
Carter is quick and correct to point out that we've seen 4.2.
There's a saying in regards to the stock market. It goes something like, bull markets start on pessimism, grow on optimism, and die on euphoria, right? And so I love that we're still not in a euphoric state in regards to the stock market. I love that the bulls are still kind of like, let's go either way. The economy, we don't know. I love that the bears are still, a lot of them are still kind of like sideline or like, not, they kind of like maybe want to trade the market, but they don't want to own the market. I love like that they're kind of over there, right? And we don't have an overall euphoric FOMO feeling in the market. That could change. That could very well change soon. I covered that on the main channel on a video, what was that, 4, 5, 6 days ago. If you want to check out financial education, my main channel, you can see that video. And I talk about there could be a FOMO cycle that actually brews at the end of this year and into next year. But we'll see in regards to that. But that's a potential. But are we in a FOMO euphoric cycle? Absolutely not. There's just no feeling that you usually feel when it's like everybody's jacked up and it's like, S&P 500 is going to 7,000, baby, 8,000. There's just not that feeling. Everybody's kind of like, I don't know, we'll see. And that's honestly the best situation. Because once you go euphoric for a while, the end is coming very soon after that, essentially.
10-year, a number of different times, both up and down. But the move from 3.6 to here has been fast. We spent 8 minutes trying to figure out what it's about. What do you think it's about?
I think a lot of the people that we talk to are surprised because basically the thought was the move by the Fed to cut 50 basis points should underwrite the long end. And in fact, when you're doing that and the economy is not going into recession in the next several quarters, when, as you mentioned earlier, both candidates are going to blow out the budget deficit. And now, in the last few weeks, there's a potential that China could at least stop exporting disinflation. That's what you get in the long end.
Julian, we're going into year end. We have an election year cycle, so there's a lot of movements that none of us are going to be able to describe the reason for them. You have new money to put to work. Do you just go with technology at this point? I believe in fragmenting it out with crypto, emerging markets, technology, not making it as complicated as it used to be. Where do you put the money right now?
No. What you do right now, GVD, 1, 2, 3, baby. You find your 3 best growth stocks. You find your 3 best value stocks and your 3 best dividend stocks. And you buy, right? And you put a little less money in number 2 and number 3 than you put in number 1, right? And you build out a portfolio that way because there's some growth companies that are great opportunities out there right now. There's some value stocks that are tremendous values right now. And there's some dividend stocks that are tremendous values. Actually, a heavy amount of value in dividend stocks that are available out there that are, I might do a video tomorrow on the main channel. I might do a video on my top 5 or 10 favorite dividend stocks right now. That might release that tomorrow on the main channel. Might do a video around that because that's where a tremendous amount of opportunity. There's still some opportunity in some of these growth stocks, but the values and divs, that's really where it's at if you're really thinking about this next couple of years.
Going forward.
So as equity strategists, we'll give you the equity strategy point of view. We love what we call the Fed rate cut playbook. Basically, you go back to 1970, you look at all the rate cutting cycles, there's a very pronounced outperformance in the year after the Fed starts cutting from infotech, surprise, surprise, small caps, which might be a bit counterintuitive considering how much they took it on the chin today, but also barbelled by the more defensive sectors, consumer staples and healthcare. So to us, that's sort of the sensible way that will help you ride out if you get some turbulence, which, of course, if there's a contested outcome, you're likely going to get some turbulence.
Is there concern that information technology outperformed on the way into the cutting cycle and so may have pulled forward gains? I mean, in past cycles, did we see this sort of outperformance as well?
We did. Again, a lot of that owes to the secular gains over the last, call it 40 years in infotech. But again, it also calls up this point, Melissa, at 24 times trailing. If we get a quote unquote clean outcome in the election that everyone says, OK, this is what happened, and we get a melt up, which is very, very possible, that's the kind of situation where, particularly in infotech, you'll be borrowing from next year's gains. But I think, again, we have to acknowledge the fact that one of the very bright spots today is the leader in the AI revolution, made another new all-time high. Very positive.
Alrighty, next one up here, buy high, sell higher.
These next couple of weeks. Let's ask Dan Greenhouse, Solus Alternative Asset Management's chief strategist, with us once again at Post 9. It's good to see you again. Is that what we should prepare for? What could be the most volatile couple of weeks? You got mega cap earnings, and then, of course, 2 weeks from tomorrow, you got the election.
Yeah, listen, we should probably have a little more volatility, although it bears mentioning that the VIX is, call it 18 right now, which considering the stock market's making a new high, is already a fairly high level. So already you have some volatility.
Yeah, but why are you not getting much volatility, right? I mean, the VIX is in an elevated place at like 20-something, right? But it's not like the market's really that crazy. Here's why. People don't have a super strong opinion where the market's going, right? As we spoke about before, the bulls are buying, but we're always buying. I'm always buying, right? I think I've bought stocks every single year. I put money into stocks every single year since I started investing, in 08? Every year. I'm always buying. I'll buy next year, the year after, the year after. Like, probably as long as I'm on this earth, I'll be buying stocks. Literally. I could be like 110 years old, I'd be buying stocks. So the bulls are always buying, right? The people that like to trade more, they're the ones that really create a lot of the drama in the market. And those people aren't super confident either way. They're not super confident about downside in the market right now. They're not super confident about upside. And so given that a lot of the trader type folks don't have super strong feelings, it takes a lot of the big movements out of the market, takes a lot of volatility out of the market. Additionally, the bears, they're not that bearish. Like the bears, they certainly haven't turned into bulls, although some of them did last year. But most of them just kind of seem like, maybe you can trade around this market right now, but you don't want to buy anything long from a long perspective. If you do buy anything, make sure you hedge it. The bears are just kind of feeling, they're not in that bearish mode of like, we're going to crash, market's going down 30%, 50%. They're not there, right? And so when the bears aren't feeling super strong, and then you got the trader types that are unsure about where this market's headed, it just creates not much volatility. It creates a kind of a market that just kind of flounders along. Individual stocks will make big moves in that amount of time, but really it's just kind of kangarooing around. I think things could change very shortly here. And, depending upon the way certain things go here in a couple of weeks, it will depend upon if the market starts to get very, very bearish or very, very bullish very, very quick.
That belies some of the historical analogies, if you will.
So I have most commentary out there today is that we're still positive, right? We're still in the uptrend. Tony Pescarello at Goldman, baseline view positive given the inherently friendly interplay between growth and the Fed. You cut out all the noise. Is that what you distill it down to like he did?
Yeah. I think it's really that simple. Earnings are going up, obviously at a slower pace. The economy is expanding at a somewhat slower pace, although still robust. And when you put those two things together, that type of an environment is traditionally positive for equities. And the better question is not, should the stock market be going up? Why is the stock market going up? The question is how best to play that, what sector, what asset class, et cetera, et cetera.
Well, I mean, you say earnings are going up, but then you sort of couch it a little bit with at a slower pace,
Yep.
which is fair. I mean, that's estimates have definitely come down. But multiples are not really expanding at a slower pace. So you got the valuation of the market at like 22.5 times,
Yep.
which is historically rich. But if you're telling me that earnings are growing at a slower pace, the rubber meets the road somewhere between that, doesn't it?
Well, the issue I have with the valuation argument, listen, clearly 20, 21, 22 times forward earnings is more highly valued than the equity market has traditionally been.
I own some silver. I love that 12-year high, baby.
Over time outside of a couple of episodes. So there's no doubt about that. And no one should dismiss that. The problem I have with
Except you right now.
Well, no, I'm not. No, the problem I have with it is I'm just not sure what I'm supposed to do with that. And what I mean by that is there was a point.
I remember it wasn't that long ago, people were laughing at me for buying silver. I remember that. Now it's at a 12-year high.
The 2010s where people were telling me 16, 17, 18 times is historically rich, and I wasn't sure what to do with it then either. Valuation is one of those things that are one of those market observations totally worth being aware of, totally worth making, but outside of the extremes, call it single digits, 8, 9 times, or extremely high levels, call it 29, 30, 31, 32 times. In the middle there, it's really difficult to ascertain which one of those metrics is worse than the other. Is 20 rich? Is 22 rich? Is 24 rich? You don't really know without the benefit of hindsight.
I think the point of discussing it and asking the question is to debate/discuss whether people who are still sitting in a fair amount of cash should get into this market now or wait because it's too expensive at a time where earnings expectations, though high, are coming in. And there are some calls that returns over the next few years are going to be kind of meager.
Yeah, so I saw the return thing, but the return argument. But before we get to that, do we know that there are people sitting in large amounts of cash? We've been in a bull market, obviously not uninterrupted, for 15 years now or so. I'm rounding. Obviously, we had COVID in the middle, and that scared some people out. But I don't really know that there's a lot of people sitting in large amounts of cash for fear of the market, if you will.
There was a lot of money. The numbers bear out. I mean, over the last few years, because of what the Fed was doing with interest rates, there's obviously was a lot of money sitting in money markets.
There's $6+ trillion sitting in money market funds.
Okay,
Fine.
that's a lot of money.
That's a lot of money. You need to scale that for something. And when you normalize that for, say, the size of the equity market, it's not particularly egregious. The equity market is 51 trillion in size right now. Put that way, 6 trillion, not that much. But part B of that conversation is, yes, there's a lot of cash, but does that mean there are a lot of investors sitting in large percentages of cash themselves? No. I'm not sure that's the case.
But I think people are asking the question of, should I become more invested at record highs? We're on a 6-week winning streak.
Our friend
the longest of the whole year.
Listen, I don't know if today, tomorrow is a momentary pause, but I'll borrow a phrase from our friend Joe Terranova. You're not supposed to buy low, sell high. You're supposed to buy high and sell higher. And that's an oversimplification and sort of a snide remark.
No, it was a title of his book. We get it. But
you're welcome, Joe.
Thank you very much.
Yeah, folks, buy low, sell high. Don't never forget that, okay? Bottom line in regards to that, and when stocks are very low, buy those things and hold them. Traders, a little bit different. Those folks, people that can look and get in, get out, blah, blah, blah. Those folks might do more of the buy high, sell higher strategy, right? Even though it doesn't work out as well as they think it works out, right? Buy low, sell high, that works pretty darn good. 2022, what an opportunity, right? Imagine you buying Palantir 2 years ago, like I was, and maybe some of you guys were. You've done very well. Imagine buying Meta 2 years ago, like I was, and some of you guys were buying. You've done very well for yourself. You've made like a decade or even decades worth of gains in literally 2 years.
Early stage of a melt-up. Let's bring in Ed Yardeni, president of Yardeni Research. That certainly isn't, I don't think, consensus, and I guess a lot of people would be surprised by that, Ed. I mean, We've seen it, but every time we see it where we start out a day sort of either quiet or down in the morning, or maybe up a little bit, and by the end of the session we're up 200 or 300 points. It's happened again and again and again. That's the characteristics. That's the characteristics of a melt up, and it's being met with a lot of skepticism. So maybe the ingredients are right.
Well, I think that when you look at the performance of the market, the best way to think about a melt up is what's the valuation multiple doing relative to earnings. And the valuation multiple has had quite a run. It's up almost 50% since the beginning of this bull market. And earnings have also been improving. So the question is this a PE-led melt-up or an earnings-led melt-up? A PE-led melt-up would be reminiscent of the late 1990s.
Yeah, but that's where they got it wrong in such a substantial way, right? Let me pause this and show you guys something here. Alrighty, folks, let me show you something here. So what we're looking at, Meta, perfect example right off the bat. Trailing 12-month earnings per share growth, 134%. So Wall Street way undervalued these sorts of, like the moral of the story is going to be like Wall Street way undervalued these big tech companies, right? Look at NVIDIA. Check out NVIDIA. And these are the most powerful, biggest stocks in the stock market that matter the most to the indexes and really dictate the market. Trailing 12-month earnings per share growth of over 400%. Let's check out a kind of a lagger stock in Google. 47% trailing 12-month earnings per share growth. That's incredible. Let's check out another horrible lagger stock. Apple. Even Apple's at 10% trailing 12-month earnings per share growth, right? Let's check out, which is double digits even for them, and they've done horrible. Microsoft, 21%, almost 22% trailing 12-month earnings per share growth. These are incredible numbers, and these are, once again, for the most important stocks that matter the most to the stock market. Amazon, amazing, big position for me. Trailing 12-month earnings per share growth, 229%. So you go through these big dog companies and you see one after another, after another, after another, with just incredible earnings per share growth, right? And that means that the market was significantly undervalued back in 2022.
An earnings-led melt-up would be more sustainable. I think at this point,
it is an earnings melt-up,
I'm pleased with what's going on the earnings side. I think earnings are going to be pretty good in the third quarter, but valuation is definitely stretched. It's not as bad as the melt-up in the late 1990s, but it's getting there.
So a melt-up, if we're already in it, maybe we're partially through it, but since the election is in only 15 days, I would imagine that any melt-up would have to span, just go right through the election and then into maybe 2025. Does it matter to you how like so many things, maybe the election is just another one of those, data points that may or may not matter much to what the market does as far as the big picture.
Yeah, I hope that's the case, but this is probably going to be a very, very close race and maybe a bitterly contested one. And I don't know that would be a good backdrop for a melt-up. The market might have some second thoughts about that. The other possibility, of course, is a Democratic or a Republican sweep, in which case the market's going to have to be very concerned about deficits being even wider and possible inflationary consequences. And in fact, the stock market's kind of ignoring what's going on in the bond market. Ever since the Fed lowered the Fed funds rate by 50 basis.
I'll be honest with you guys. If it's a Dem sweep, I'm going to be honest with you guys, we're going down big. Like, I don't think that's going to happen. But if it did, oh my gosh, because the market is not expecting that at all. And then that would basically almost guarantee corporate taxes are going up big. And going up to the 28% number from the 21% number takes 7 percentage points away from companies each year and puts it in the government's hands. Telling you, that would be full market freak out. Then additionally, you would have a feeling of like no real M&A being allowed in any major way for the next several years, for at least the next 4 years, right? Man, it would be devastating to the market. I'm just being honest with you guys in regards to that. I don't see that happening, but man, it would be rough.
Guess what? The bond yield's going up by almost 50 basis points. And so the bond market's signaling that bond investors, my friends, the bond vigilantes, are starting to stir. They're not particularly happy with the potential inflationary consequences of what the Fed did. Because the Fed, I think increasingly it's clear, they might have overreacted with the 50 basis point cut. and stimulated an economy that doesn't really need stimulating.
So what's the thesis for earnings growth continuing to be solid and above trend? Does that include, right. Are you talking global? You talking China? Are you talking Europe recovering, or everything here in the United States?
Yeah, everything here in the United States is basically the story. I'm not that convinced that China is going to be able to stimulate its way out of a historic bursting of a real estate bubble. And Europe still has lots of issues, like competition from China. The German auto industry is getting really clocked by what's going on with China's exports of electric vehicles. I think the U.S. continues to surprise to the upside. The labor market, at least in the latest data, looks pretty good. You know, if you don't like the latest data, wait for the next batch and maybe there'll be a revision. But I like the latest data. It looks pretty strong. The real GDP is tracking at over 3% for the third quarter. There has been no labor.
Somebody was driving their Model Y on the left side of the street. I'm like, you from Europe? What's going on here? You're like, get over here, get over here, get over here.
There hasn't even been a soft landing, quite honestly. And as a result of that, I think earnings are going to be quite good. And I think the part of the story is the economy's resilience, and the other part is productivity and profit margin making a comeback. So the earnings side is pretty good. Look, my melt-up concerns, I try to convey my concerns by providing some subjective probabilities. And when the Fed lowered the Fed funds rate by 50 basis points, I raised the subjective probability from 20% to 30%. I'm still using 50% for what I call a roaring 2020s scenario. And then the rest of the 20% is trouble, geopolitical problems, and maybe even domestic political problems.
Ed, even though I said the election doesn't matter, so what do you think could impact earnings?
This election matters significantly to the market in the short term, significantly.
Positively or negatively. So on the one side, you've got...
That's not always the case either. I didn't feel like that. I didn't feel like that in 2020. I didn't feel like that in 2016. I didn't feel like that in 2012. This election matters significantly to the market in the short term. Significantly.
Ability of more tariffs. You've got more than a few tax cuts on the table. The 2017 would be extended. We've heard even the SALT cap might come off. On the other hand, if the Democrats were to win, you could conceivably have corporate rates go up to 28%. You could have capital gains rates increase. You could have quite a bit of spending on social programs. I mean, there's a lot of different things we're talking about.
A lot of different things.
Which would be more of a threat to your strong earnings case?
I think you've covered it pretty well, Joe. All of the above. I'm rooting for gridlock. Our founders came up with this system called checks and balances. On Wall Street, we call it gridlock. And I hope that all the extreme policy proposals that both Trump and Harris have made just run into gridlock. Some of them are extreme on the tariff side, on the tax side for the corporations from Harris. And so I think, the market has ignored politics, and I think rightly so, but I think it may be harder to ignore politics once we see what the results are. If the results are gridlock, then I think melt-up is actually becomes more possible because then there's some of the extreme populist policies. Both politicians are promising their base everything they could possibly wish for. I'm wishing that the political system gridlocks on them.
Yeah, we'll see. It'll be here before you know it, okay? Appreciate you all joining me as always. Hope you enjoyed today's video. Once again, if you want to join my Patreon, support my content, plus see the stocks I'm buying and selling each week, all that good stuff, there'll be pinned comment down there. Price will be going up 30% on both the tiers here very, very shortly. So I'll just be aware of that. But as long as you're in before the prices go up 30%, you will be grandfathered in and you'll be all good. Much love and have a great day.